Hello everyone, welcome to the Prudent Finance Great Conversations podcast. Today we are incredibly honored and thrilled to welcome a true titan of financial engineering to the podcast, Dr. David Shimko. With a career that spans Wall Street, boardrooms, and elite academic institutions, Dr. Shimko is the very definition of thought leadership in modern finance. Currently serving as a professor of financial engineering, he has spent decades shaping minds, structuring financial products, and solving some of the most complex challenges in risk management, derivatives, and capital markets. He has held pivotal roles as board of member, CFO, director, scholar, and industry professor across top-tier firms and institutions, including NYU Tandon School of Engineering, Wall Street Scholars, and so on. With a Ph.D. from Kellogg and powerful dissertation applying option pricing theory to insurance, Dr. Shimko has redefined how we think about illiquid assets, credit structuring, and collateral risk. If you are passionate about quant finance, valuation under uncertainty, or how to navigate financial innovation in volatile markets, you are in the right place. So stay tuned and follow us because this episode will be packed with wisdom, strategy, real-world insight, and of course, great conversations.
Thank you, Shubham, and thanks for your kind words. I feel very flattered.
Thank you. It's an honor to have you, Dr. David. And I was so excited for our podcast. I was researching about you and I got to know that, yes, he is the right person for our podcast because I was so into getting requests for doing a podcast on financial engineering, how it's shaping up with the new coming up ideas, how the world is changing of that particular broad Prospera, to be honest. And for my question, which I believe in the financial engineering world is quite dramatic, to be honest, because it changes quite well, because new models come up, new things come in. So we'll start with first introduction to yourself as well. So we can go back in time and explore what education, how you brought about to this place and how you explored financial engineering and chose this path and what excited you about it.
Wow, that could take the whole hour, but I'll try to do it very quickly. I started my professional career with a Ph.D. in finance from Northwestern. I went to work on the tenure track at the University of Southern California. I stayed there for 6 years, and I really enjoyed my research there, including publishing something on crack spread options, which is still in use by the Chicago Mercantile Exchange. Okay. But I was kind of disappointed that I only had 6 people reading my research, it seemed, because it was a very specialized area, and I had an opportunity. One of my PhD students had invited me to come interview with JP Morgan. I said, wow, this would be great. I can learn so much, right? And learn how to apply what I had been doing in derivatives to much broader questions, which is how should companies manage themselves, including derivatives, but in a way integrated with corporate finance. And all other things like reputation management, all the real problems of risk management derivatives, but in a very real way. So there was the best job of my life working at JP Morgan. I left there when our commodity group exploded and went to Bankers Trust to head an advisory group. And then when Deutsche Bank took over Bankers Trust, I took that advisory group and outside of Deutsche Bank and created a company called Risk Capital Management, which is a award-winning risk firm with fantastic people. I still stay in touch with many of them today. And we were delivering really great solutions, mostly to the energy and commodity industries, but also to the financial sector. Yeah. So I guess I would say what I like about my career is it has those 3 aspects. The academic aspect, on one hand, was where I started, but then the practitioner aspect, working for a major and a very high quality bank at JP Morgan with top quality clients around the world. And finally, the last one, which is a consultant, which is where you take this side of the people who get their products, right? Their financial products from banks. Correct. So that's how I think of financial engineering. Then to get back to your question, is that it's a combination of disciplines, like chemical engineering applies chemical theory to practical problems. So financial engineering should apply theoretical knowledge of finance with practical problems in finance.
Got it, got it, got it. No, it's quite kind of exciting to know your story as well, and surely like it's a change of perspective as well as insights which we get. So following up on that, we have another question for you. So you have worked at the intersection of academia and applied finance. So how has your view on risk evolved through those two lenses?
That's a very good question. I think I usually break it down into two things. That if you have an academic lens, if you have that background in your life, you tend to look at things with the goal of rigor. Like you want to attack that problem with rigor. And sometimes you do it so rigorously they can become irrelevant. So the thing is, if you're a practitioner, you're focused on relevance primarily, right? And if there's going to be a compromise in rigor. And I've always felt that having both things in my background, I was better able to address problems by combining rigor and relevance, right?
Okay.
Now, as for risk management, I think that's just actually the hardest of the finance professions. Derivatives valuation is easy by comparison. Why is that? Because risk is comprised of all markets, all human behaviors, all acts of God. That's all risk management, right? How are we going to recognize those risks and price them? Back in the 90s when I was at JP Morgan, we were doing value at risk. And of course, there was a ridiculous risk measure. Everyone knew it, but it was a heck of a lot better than nothing, right? It was a critically important first step because it raised people's awareness of the need to measure risk. Because if you don't measure risk, you're going to squander it, right? If you measure it in investment, then you take the right amount of risk, and pay the right price for it.
Yes, correct.
As far as risk measures themselves, have they really improved? I don't think really. I mean, if you add, scenario analysis and this kind of thing, yes, there's awareness has improved. I think machine learning models, they use historical data. They don't, have preset notions of what risks are, so they may do better. But I think that the best models that are not yet invented will be looking to incorporate risk factors that were never even realized. And that's kind of my hope for AI.
Got it. And I think the quantitative models which we predict and make as well are basically so much dynamic that each and every customization requires different modeling for it as well. So so according to that, my second question would be it will be specific to some real world like problems as well. So what does a financial engineer actually solve while working for, let's say, companies like JP Morgan or companies like Jump Trade and so on? So what exactly are they solving, or whether they are focusing mainly on building them and applying those models firstly?
Oh gosh, there's such a wide range. I mean, there's some people that are doing valuation problems, right? Your evaluation on an exotic option for a client, for example, right?
Yes.
You could be looking at building a risk management model for your complex natural gas book, right? Which has lots of different natural gas trades with different maturities, different counterparties, different terms, and all these things. You have all the normal trading activity of the bank. I was mostly involved in structuring, client advisement. So building models, not models, but products to solve people's problems, right? And also, in my case, giving them frameworks to think about the intersection between risk management and corporate finance, how to understand how to make risk add value, or how to avoid things where risk management may actually hurt your company. So,
Got it.
Yeah, I mean, there's so much for quants to do. I just scratched the surface.
True. And I believe that speaking about you as well, as a board member of Wall Street Scholars as well, and even a professor now at NYU Tandon, you must be thinking that there are so many problems which are coming to our way, and they are so uncertain as well. The world is changing. So many macro details are coming in as well. So I'll ask you another question about it. That can you break financial engineering? What actually truly means today and how it was defined 20 years ago. So what is today versus what it was 20 years ago?
Okay. So I have a good example. I've been working with a co-author called Nadia Babai on a paper called Dynamic Implied Probability. If you go back, 20 years ago, what are people doing? They're basically using the Black-Scholes model. Black-Scholes model says that the distribution of returns is positively skewed. Value is strictly greater than zero, and so on. It's a very stylized model. It was brilliant for its time. And to make it work, people calibrated it to the market. So they got different volatilities for every option, which made it very difficult to really analyze it. But we went along with it. We used Black-Scholes all the time to do this. Calibrate it, stress test it, deploy it. Now we've done something different. In Black-Scholes, you say start with the stock price, assume a stochastic process, and then you end up with an option price. And we say, well, that's somewhat crazy, right? Because we know the stock price. We have no idea what the stochastic process is, right? X-N. But we do know what the option prices are. So why don't we invert that logic and say, let's figure out what is the implied stochastic process. The way we do that is we look at the back in the 90s, I published a paper, one of the first ones on implied probability distributions from option prices. This does is borrows on that literature, including my paper and many, many other good papers in this area. But how to use the implied probability distribution to store information about those probability distributions over time. And so we track the moments of the distribution, and then we can see what's really the law of motion of all the moments of the probability distribution. And this opens up a whole new world of pricing, because now you empirically determine the stochastic processes. And to make your work even better, you use machine learning techniques to build better models than you could with just sitting down and with a piece of paper and saying, what do I imagine the stochastic process might be? So I think we've submitted the paper for publication. We're hoping it's going to make a big splash, and it'll be available on our website on Wall Street Scholars.
Yeah. Do send us. It will be exciting for our audience to see the paper as well. And hopefully, if someone is writing their own paper, they will cite it as well. So thank you so much for that insight. And I also believe that when an option is priced, it all depends on how actually we are basically creating that model as well, as rightly said by you. And also there is so much of you can say micro details as well linked to it, that you need to basically put the right strategy, or maybe apply 2 to 3 strategies as well to exactly get your pricing model correctly as well. So coming to the next question, on which it will be quite good for our students as well, as to what are the biggest misconceptions or which the students and practitioners have about risk management, and how they should change themselves with the changing world and uncertainty. So usually people, what they do is they see the trend and hop on it. But what do you suggest that what all changes do you are seeing in this world, to be honest?
There's so many interesting parts to this question. Thank you for asking it. One of it is we recently realized that we've had a drop in enrollment at NYU for people getting risk management degrees. And at first you might think it's because risk management is less popular, but I think that's not it. I think what's happening is with the change of administrations, one administration favors heavy bank regulation and one favors no bank regulation. And so the need for risk managers is going to fluctuate with whatever the administration is in charge. Yep. So it's a natural thing. It ebbs and flows. And banks, they're required to have risk management, right, under some administrations and not under others. So, then that makes sense, right? People are going to go for those jobs. When it looks like there's a lot of demand for risk management, they're going to go for those jobs. But I like to break into 2 parts. I like to think of the banks on the one hand, who have mandatory risk management when they have it, right? And mandatory hiring in that area. But look at the non-financial firms. In those cases, I think it's almost more interesting because risk management is a voluntary decision, right? Should we take this particular risk? Should we not? Should we hedge? Should we buy insurance? All these decisions, they affect the capital structure of the firm. So it's a legitimate corporate finance topic. But yet, I don't think you'll find a single corporate finance textbook that has a serious treatment of risk management as a corporate finance core function. So when I advise students about risk management, I say, well, think about it in 2 ways. You can go work for a financial institution where risk management is mandatory, and you'll be, either executing, models that have already been written, or building your own models in some cases as you get more senior. But you're satisfying a regulatory constraint. Right?
Yes.
But if you go to an asset management firm or a hedge fund or an energy firm, you're doing something quite different. you're thinking about risk management from a point of view like every other corporate activity. How can this add value to my enterprise? Okay.
Yes.
So I like to think that, corporations, non-financial institutions, and even banks, I should even say, they have two types of constraints. They have cash constraints, which you can call capital constraints, which everyone understands.
Okay.
But they also have a capacity to take risk, and that capacity may be limited. And they have to decide if you don't, if you're not careful about how you allocate the risk, then you've allocated it all out, right? And have you made a sufficient return relative to that to make that the right choice? And only in the CAPM in the 1960s do we have such a theoretical environment where you can assume something like capital markets are infinite, all risk can be fairly priced, right? And there's no cost to idiosyncratic risk. All those conclusions actually tend to be incorrect.
True.
So what I found is because of risk management, because of learning risk management, I've had to rethink my understanding of corporate risk management, in corporate finance in general. And I've written also a presentation. I give a talk on it once in a while called "The Most Beautiful Equation in Finance," where I show the correct way to look at all assets and contracts in finance. It comes from the understanding that there's two types of capital: cash capital and risk capital, and the relative pricing of those two types of capital determines the value of every single asset in finance.
Yes. No, it's kind of good as well that we are in a changing world, and we learn a lot by seeing actually what is redundant and what is not. And on working on these models, we try to see what is the different aspects of those quantitative models which we are preparing, as well as incorporate and bake them in on our strategies, whether we apply any strategy onto them. So talking about strategies and seeing the world being changing towards technology, and I see that traditional finance is there. We should read books and so on. But how do you see that AI and machine learning is changing the landscape of financial engineering? And do you believe that students at present, or even professionals, finance professionals, need to apply both, you can say, the bookish and the traditional knowledge, plus these tools in tandem, to be honest?
Yes, I think there's two parts to that, and I like the way you phrased it. As far as AI and ML models entering finance, yes, and consider them as augmenting the traditional frameworks, but I like to think of it as almost like the traditional frameworks are a benchmark. And so the challenge is for the ML model to beat the benchmark. So whenever I do work in this area, I'm not an expert, but I have colleagues around me who are experts. We start with the traditional framework and then say, by how much did we beat it with an ML model? And do we believe in the model enough to accept its incremental benefits, the incremental benefits grade, compared to some of the risk? I think of, sometimes overspecifying, the risks of not tuning the model correctly, and all these other things that go with ML, for example.
True.
So it's a big part of our consulting work at Wall Street Scholars to take value at risk or simulation, to take hedging policy and strategy or optimization. So these models work really, really well, for the most part, and you just have to watch out for certain crazy behaviors. But if you're careful about not how should I say, not misspecifying what you're trying to get, then you can actually get a really great outcome.
Yep. And I believe that we need to first learn also these AI and ML models before applying them, because it can be a misconception on our overall knowledge and models which we are applying to our strategy as well. So we need to incorporate it properly, and I believe that professionals who are pursuing risk management as a profession, as well as quantitative finance, they would need to have a reliability on the already built, you can say, rules, some models or some strategies which are there from like years, which have been proven, and we need to use that only, and then you can say, what do you call, use this AI and ML models as well to make sure that we are in tandem with our work and our strategies. All right. So it was an exciting insight from you, Dr. David. Thank you so much for that. Quick question to that, which you talked about, like basically how you plan in different companies and how you build models and do the risk management depends on the company's goals and what exactly the company wants. So could you tell us about your patent involving like illiquid assets and how this framework can change capital allocation strategies at present, to be honest?
Yeah, I think I've been working for many years, ever since I was at Bankers Trust with my colleagues there, to come up with a way to solve a problem for trading firms in the energy business.
Nice.
Basically, what they were doing was they trade with each other, but unlike banks, which have infinite collateral to use to support their trading activities, the energy firms were very limited in terms of their cash collateral for posting margin. But they had lots of assets, right? Gigantic assets, like world-class assets that they owned. And it seemed to us that there's a disconnect, right? That there had to be a way to solve this problem. This is back in 1999. And what we thought was, well, I guess it was a precursor of tokenization. So the idea is if I could take an asset, like an oil rig, for example, and use that as collateral, put that into a kind of a structure where we had the asset would belong to the structure. The structure would have a liquidity facility attached to it, so that in the event there was some kind of loss, you could draw on the liquidity facility. But you could basically tokenize your energy asset. So you say, okay, I'm going to get this $100 million, or probably much more, right? $500 million offshore oil rig to be a source of collateral. Okay. So what you can say is, I'm going to hold that as collateral in a centralized way through this token mechanism, and then basically give people claims on that token when they have gains on trade from that trading partner.
Okay.
So completely make that the exchange system among the energy companies much more efficient than even the bank system, which still uses cash in many cases. It's cheap for them, so it's not that bad. But with tokens, it's even less. So if you think about this in a broad scale, I had 3 different patents in this area. If I can do that for energy companies, tokenize their assets to use as collateral to make a completely frictionless exchange, or I could tokenize my house, or I could tokenize my insurance policies that have some kind of liquidation value. I could then guarantee transactions easily, like my kids' mortgages, or if I'm trading futures, I could use that to guarantee my futures margins. I could even sell that capacity to others to earn a return.
Yes.
And this is all reinforcing the idea. This is not my cash capital at play, but it's my capacity to take risk. It's my risk capital.
And I was working on one of a research professors in Harvard, and we were working on insurance policies, basically in Florida. And during that paper, I realized that sometimes there is a special purpose vehicle which is being created, or a bundled loan type of a thing, just as a tokenization thing which you told about, and those bundles are then put forward to the investors, and their money is put in there. So, but I believe that what is the risk, or is there any credit ratings for them as well done by a third party, or because there will be a huge risk on those tokens, because there will be a domino effect. If one fails, then another fails. Similarly, in the 2008 financial crisis, which I'll come up to the next question as well. But do you believe that there should be like there is a credit rating so that we get the right bundles or those tokenizations for the investors?
So the way that we structured it back in 1999 was a slightly different method. So we said, let's put the asset in the SPV, and we're going to attach a liquidity provider. So the liquidity provider, for example, let's say it's going to be, I don't know, JP Morgan is going to provide a contingent line of credit that's not revocable. So if there is a loss that is going to be this funded by this asset, that can be converted to cash through the liquidity facility that JP Morgan has provided.
Yes.
So In other words, we'll have the same credit rating as JP Morgan would have on that token, if you will.
Mm-hmm. Good. No, I absolutely understand that. And they basically design the derivatives and structure in such a way that like you can create those trading strategies properly, and as well as those portfolios are having different qualities as well. Some are of low quality B grades one, but some are like AAA top notch quality as well. So, all right, thank you for that.
That would limit the liquidity facility would then limit its lending to those risky assets, right? They would take a usual sort of haircut and say, okay, we'll only lend up to 50% of the value. Okay, which then that first 50% can be considered tokenized, even if the other percent is not.
Yes, true. Yeah, it's so exciting, and it's like an ocean which we know a bucket of full of knowledge of about. But yeah, it's quantitative finance is so interesting, and I believe that I might switch to that as well someday soon. But coming to that, so. I've seen your journey, and I've seen other people as well. I've seen come across students who are pursuing financial risk management certifications. They are doing risk management. They are also doing like masters in quantitative finance as well. So do you what all skills you think of people who are interested in these subjects and people who are interested to do these things should have at present times, and they can be both. Some people are that they have pursued a wrong career path. They were not aware of something, and now they want to pursue that, and they want to change or switch to that. And some people are already pursuing it, but they are not reaching that level that they want to reach, or they're not getting that type of knowledge. So what and according to Wall Street scholars as well, like how do you believe that we can shape up this whole professional journey of a person who wants to dive into quantitative finance and risk management?
Yeah, I think it's a common thing. I meet so many people that are very talented at this. They know the math, right? They know their coursework. They know they're professional people. They do solid work, and yet they somehow seem not to thrive in some cases. You wonder what that is, and maybe I feel lucky in my case. At JP Morgan, I was able to not only interact with top people at Morgan, but I was able to go travel the world and meet managing directors of these top commodity firms. People who didn't know any mathematical models, but had such excellent knowledge about their business that they could challenge anything outside, right? That caused me to change my mind on a lot of things and be open to really thinking differently about what my role was, what I was doing, what was important, and what wasn't important. So I think the first thing is to get that kind of exposure to those mentors, right? Whether they're internal to your organization, whether they're the clients of your organization, whether they're external, whatever they are. But you need people to be constantly stimulating you to think about those ideas and how to rethink what it is that you're doing and what's you're successful. So you might be surprised. I'm not going to focus on being better mathematician, okay, or a better programmer. I would say my advice is for all people, right, in their jobs to, number one, build productive relationships. That's senior relationships and junior relationships. The seniors, of course, can pull you up when they leave the company. They take you with them. Juniors can support you, and you can help them in the future. And then your peers can help you find a job when your hedge fund explodes.
Yes.
Second thing is to focus on communication. I've seen so many people with great models, right, but they can't communicate them. They exist in Python, but they don't exist in the real world because they're not
how to present them. Yes.
Right? So not only does the work have to be rigorous and high quality, which it often is, it has concise, informative, but it has to be communicated well and in a way that people can access it and use it. And finally, try to think a step ahead in your career and recognize and build that end state. If what you want to be is a world-class scholar, or do you want to be a managing director, what are the pieces that need to be in place at each stage in your life to make that happen? And you can't rush it, unfortunately. There's a lot of patience involved. But I think my most successful friends are the ones that stuck with one of these ideas. I want to be either a world-class scholar or I want to be a managing director. These are the things that are important to me. Me, I feel like I didn't, I could have done better, right? I think I did well in many respects.
I don't
always
believe that
going
seeing
back
your
and
background.
forth.
I don't believe like seeing that your background, it's top notch, but yeah.
Thank you. But I feel like I was going back and forth, right? From Wall Street to academics, to consulting. And I was having a great time and learning so much. And I felt like I was producing a lot for sure. Everyone should have doubts about themselves too, right? And think about, what they can do to make sure they're successful in that end state.
Yes, true. And such a good point you pointed out that some people are good at theoretical part of it. They know how to like build models, build strategies, but they're not able to communicate them in such a way that the user or the person who wants that model is not able to use them. So it's basically either it's present or it's boom, it's not there, void. So I think students and professionals will see this and learn that they should basically market and sell their products, and basically even not sell, even if they're building a product, at least they talk to 5 colleagues, talk to their managers, talk to some of their professors, show them, okay, I built this model, can you tell me your feedback, how do you like it, build something great with them. So I think the communication part of it and the presentation is truly amazing, which I got an insight from you. All right, so a couple of questions and then we can end this as well. So we talked about often, like there are some famous strategies like Black-Scholes model, and there are some MBA strategies as well. What do you believe that do we need to like change, and I won't say change, but update these strategies at present? Are these strategies still valid in the coming times, seeing the macro and microeconomic uncertainties? And also, do you believe that there is a need to in quantitative finance to build more such good quantitative strategies in the coming times?
Okay. Well, I guess I'll reply with respect to option pricing. That's really my primary expertise, right? Think about the 50th anniversary of Black-Scholes passed a few years ago, right? And it made me think that how is it that a model has survived this long when it was wonderful at the time. I mean, don't get me wrong. I don't mean to minimize it in any way, but the model itself is crazy, right? It's in terms of just defining risk in equities, for example. So equity returns are negatively skewed. Equity returns are high kurtosis associated with them.
Yes.
They have jumps of all kinds of things happening. And how are we? We've done a good job, I think, of adding things like the Heston model, right? Stochastic volatility. Putting in jumps, and calibrating the models, always starting from the same idea. And I think it's important to go back to these fundamentals. And I have 2 examples in my research where I've done this. The first one was recognizing that I described this dynamic implied probability earlier. So I won't spend too much time on that, but just put that in this context is to say, working on solving for the stochastic process rather than the option price, because we already know the option prices. And using machine learning and AI to help in that process of determining the stochastic process. That's a very modern way of looking at it compared to, saying that the log returns are instantaneously normally distributed and positions are infinitely divisible and there's no transaction costs, blah, blah, blah. So this is an arbitrage model. It's a very good model. And my response has always been, it's not an arbitrage model. It's only an arbitrage model under the assumption of 0 transaction costs, right? Infinite divisibility. So you call it arbitrage? It's not, So furthermore, you had to calibrate that model. You spend years, and people have written volumes of books on how to calibrate Black-Scholes model to the real world, creating these vol surfaces that are multidimensional. It's not necessary. Right? It's necessary to go back and question those foundations and change that model. So that's what I believe we did with dynamic implied probability. The other one was going back, I was trying to figure out why it was every university offers different classes in, let's say, you have corporate finances in one class and you have derivatives in another class. Right? Rarely the same class, right? And, I was trying to teach my students at NYU, and I was trying to transition from the sort of cash flow models to the option pricing models. because
Okay.
I discovered that there's a problem with the CAPM. And the problem with the CAPM means that, at some point, Professor Sharp made the assumption that the expected returns and standard deviations of all the securities right before you do your portfolio optimization. And furthermore, that those values are in equilibrium. That's a strong assumption, but let's face it, it's a first attempt, so it's not bad for a start, right? But what happens when you then go down the line and you conclude, as you do in Sharp's CAPM, that there is, therefore, there's no price for idiosyncratic risk. Right? When you're diversified, right, there's no cost of risk, and that's why the risk premium is proportional to the market risk premium, right? So if you push that back a little further, say, what if that assumption got you there, that there was a compensation for risk, but it was already in the expected return?
But what about the beta for that asset? Like, do we manage the same way as the market
I
premiums?
think the beta is, I'm not denying the beta. What I'm denying is that the residual thing, right? In the CAPM is that there's the beta part, then there's the residual part, which is stochastic, right? But that has no price. There's no compensation for idiosyncratic risk. So that's what I'm really focusing on here. But what I'm saying is that because the assumption that Professor Sharp made, that pricing of idiosyncratic risk is already in the expected returns.
Yes.
Okay, so that was a real wow. That was a learning moment for me to discover that one assumption made in 1960 or so shaped the whole future of finance. And luckily, there's another model by Lindner. Both Sharp and Lindner won the Nobel Prize, by the way, for for work in the CAPM. But Lindner took an approach which is actually a kind of a precursor to the Sharp approach, wherein he derives the expected returns, not assumes that they're in equilibrium.
Oh,
and therefore you can see exactly what the risk premium is for idiosyncratic risk in the Lindner model. It's properly adapted. So I don't know if I've overwhelmed you, but these are things that I found by going back into our history as a profession and trying to find those things that have divided us, right? On value, for example, and risk, understanding risk, and really trying to figure out what it was that got us to the point where we are, and then trying to fix it.
No. It's to be honest, when I was studying in my grad school fixed income securities with my professor, I was you can say excited about like carrying out these strategies. But when it came to practical knowledge, when it came to the actual tests which were given to the classes, they were so different answers because everyone applied something else. So and then our professor told that what was the right strategy and how to apply it, even CAPM models or maybe Sharpe ratios, tenor ratios, and so on. So that's quite exciting to learn about it. And yeah, so one penultimate or final question we can ask, and this will be related to your advice to basically students who are thinking to pursue a course in quantitative finance. So nowadays they are either doing a job as well or they are just students. So what do you suggest, that should they start with some research papers? Do they write some research papers, explore about them, or are there some courses out there which they can pursue, or and what all skills they should start with? Firstly, they should start with some traditional things, or they should also start with some technological tools. Do you know some technological tools or models which they can, and that are free of cost as well, if to be honest, which may be free, may not be free, if someone can start with free and then buy those tools? What all they can do to basically dive into this?
Yeah, I mean, I could answer your question different ways for people at different stages in their development. So I guess what I'll do is choose like a beginning level master's student at NYU.
Okay.
Just as a reference case. Okay. So there's, I guess the first part is there's going to be some fundamental stuff which you're going to have to get good at, right? One is going to be, all the college level mathematics up through, differential equations, at least the whole calculus sequence, including linear algebra, to be great. A lot of linear algebra is used in machine learning, by the way. And so that's one part, is the sort of mathematical background, a lot of probability and statistics, and have those solid, and hopefully that came at the undergraduate level. But if it hasn't come, you need to get back and reinforce that.
Okay.
The second thing is the programming side. We have in our program, we have a requirement for programming in Python. Doesn't have to be Python, of course. You can have your tool of choice. I think Python's great. It's easily communicated. You can port it into Excel. Use Excel as your GUI, and really Python can then be used to communicate with the outside world.
Yes.
About your work. So you should be good at Python. You're never going to be as good as the best people are, I've found. I mean, there's some really amazing people out there who specialize in it. If you're a financial engineer, maybe you shouldn't necessarily be the best programmer, because you're supposed to be solving problems, right? And finding out what resources to bring to bear to solve those problems.
True.
So then what? So if you were in my class in valuation, what I would do is say, okay, we're going to have that kind of a textbooky approach for the first half of every lecture. We'll give some background knowledge, how to do simulations, right? How to build certain kinds of models, how to price, derivatives, whatever the theoretical talk is. But then we always go into projects.
Yes.
And this is where I find students get a lot of a boost. Is that in the course of doing a project? Like my first project in that class would be to build a zero coupon bond term structure. Okay. Using all the coupon bonds that trade in, for example, U.S. government issued debt.
Yep.
And so build a model. Sounds like it's a very straightforward thing. It's a very important thing, right, for every bank to do. But as soon as I realized all the details involved in building an accurate zero coupon bond, risk-free term structure. And so in the process of working on the projects, they're forced, right, to ask questions and get them answered in order to get the correct result. And we can compare the projects the different groups do and see how well they did, because there's a definite appearance of what the right model is based on how well it fits the actual market prices of the bonds and how well it describes the shape of the term structure. How does it price new bonds, as well. So they did this project, or they might do a project where, let's say, I would have them simulate natural gas prices. Okay.
Oh, that's nice.
Something that is very. It's a difficult problem. It's not the most difficult problem I can imagine, but the point is, it helps them to think about. Oh, gee, I can't use a geometric random walk. I can't use a meter learning random walk. We'll have some jumps or some hybrid model. How should I go about doing this? And it forces them, right, to figure out how to choose a stochastic process. And of course, like we were talking about earlier, they would have to reference the data somehow. And in the absence of an ML model, try to figure out what kind of other model they would apply to simulating natural gas using data, right? How to make that. So these projects, I think by the end of the term, the students really focus on that as being the most valuable part of the course is the projects.
Yes, that's true.
Where to find these things? I don't know. Maybe if you went online, you could possibly find some projects in financial engineering. Would be a start. I don't know. My textbook has problems, but it's not published yet. But you could write me for.
We'll wait for it. Yeah. We'll wait for it, and we'll wait for also for Wall Street Scholars insights if there are any things or lectures coming in on that as well. We will surely say to our audience that yes, it's a true place where we can go into rely on the knowledge which it's there, and we can get new perspective, because perspective matters. The knowledge can be got from like ChatGPT as well, but it's the perspective or your view on that knowledge, how the professors like you portray that particular model or strategies to our community, that matters the most. So thank you so much, Dr. David. It was so exciting to have you here, and we'll wait for another episode with you sometime later after 50 episodes and so on, when we'll realize and see, okay, Dr. David, I did this with you, and maybe my mind perspective changes. Maybe some audiences reach out to you as well and ask some questions. So do give them a feedback on email as well. Thank you so much for doing this podcast with us. Our audiences will surely enjoy it, and it was a great conversation to have you with it.
Thank you so much, Shubham. It was really great. And it's so important to sit back and think about these big issues that you've been raising. And I'm happy that I had some decent answers to most of your questions anyway.
Yeah. Thank you, Dr. David.